Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report. Inflation rose to 3%. Core inflation dropped a little bit to 3%. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, we've actually added this to the website. I don't know if I've shown you guys this on the public channel here, but we have this macro calendar. And so rather than me trying to go around to other websites and find everything, now we just have it all under one roof on the Into the Cryptoverse website. So you just go over to the macro and you click on calendar, and then it comes to this page. And what you'll notice is that the inflation rate came in at 3%, a little bit lower than the expectation of 3.1, but a little bit higher than last month of 2.9. Core inflation also came in at 3%, a little bit lower than last month of 3.1 and lower than the forecast of 3.1. What's really interesting is that, inflation has been moving in the wrong direction, right? I mean, like, and this of course just shows a lot of different countries, but if you zoom in, inflation in general, let me just go over to the United States. In general, inflation has been moving in the wrong direction since April, okay? Because back in April, headline inflation was at 2.33%, and it just kind of keeps on moving up. Like every month, it has been moving up since it hit 2.33%. And so what's really interesting is that inflation continues to move up, but no one really cares. Right? I mean, like, at least no one at the Fed. Because if you go to look at CME Group and you take a look at sort of expectations, right now there's a 98% chance they're going to cut rates on October 29th. There's also a 91% chance that they'll cut rates again in mid-December, right? December 10th. So inflation's moving up, but no one's really that concerned by it. And if you go back through history, with it moving slightly up, historically, no one really cares, right? There's plenty of times where inflation's moving up. No one really cares. I mean, like, go look at 1998 through 1999 and 2000, right? I mean, inflation was moving up, and no one really cared about that for a long time, right? And then eventually it kind of stalled out. And then, of course, we had the dot-com crash where inflation just kind of basically fell off a cliff. We didn't go deflationary like we did in the financial crisis, but still we saw things come back down. And so the Fed doesn't really seem that concerned. If you go back to like the 70s when we had periods of high inflation, you'll also notice that like inflation was able to go up in 1972 and the market didn't really care, right? I mean, it went from like 296 up to 386, and the market just kept putting in new all-time highs. But when it moved up from 3.8 to 4.8 in a single month, that's when the market cared. But when it has these like little moves, the market doesn't really care. So yeah, it's true that inflation came in below expectations, which is a good thing. But even if it had come in hot, right? I mean, unless it came in really hot, the market has a history of just kind of shrugging it off. Okay. So what I want to do really quick, I mean, if you go look at what's sort of driving this, and you can look at the year-over-year contributions per category of headline inflation, and we can just kind of zoom in over here, and we'll just go through it one at a time. This is headline inflation. You can see that it's worked its way back up to 3%. 3.02%. The last time it was at 3% was back in January of this year. So, right, it kind of found a local top in January, went down, and then it just came right back up. If you look at 2024, you'll notice that it went down into September and then started working its way back up. So, I mean, there's some cyclical component of this, right? It's a stochastic process to get inflation down to 2%. But what's interesting is despite the fact that it's moving in the wrong direction, the Fed doesn't seem phased. And if you listen to what Powell has said, it makes a lot of sense, because he's basically saying the rate cuts right now are not they're not in response to bad data, right? I mean, we know that because if inflation's going up and they're cutting, you could say, like, what are they doing? Like, why are they cutting if inflation's going back up? Like, it doesn't really make a whole lot of sense. You could also say that inflation hasn't actually been at their 2% target since February of 2021, right? Like, below, or at least, because I mean, after that it was 2.6%, and we know the target's 2. So I mean, it's been like 4.5 years. So there's some discussion here as to how can they say 2% is the target if it hasn't been there for 4.5 years and they're cutting rates, right? Like, this is one of those things where it's like, watch what they do, not what they say. But on the other hand, you can also kind of understand where they're coming from, because if they were to wait too long, right? If they were to wait too long, then they run the risk of, going well below 2%, and also potentially a disinflationary crash or a deflationary crash like we got back in 08 and 09. Now, I don't know if that's going to happen, but, and a lot of people listening would be ecstatic if prices went down, right? But here's the problem. If prices start dropping at the grocery store, and, when you go out, right, if they really start dropping across the board, then it typically means asset prices are getting annihilated. So people that do not invest, generally speaking, they would love for prices to come back down. People that invest, while it would be nice if their grocery bill weren't so high, there's also this, collateral damage that occurs from those bills actually dropping, and that's their portfolios go down. So it's a tough situation, because it's not like the Fed wants for inflation to then like roll over and to then respond. Because again, if you go look at 2000 and what happened back then, right? Like, inflation started to go back up, and then it dropped. But when it dropped, it went all the way down to like 1%, and that was during that dot-com recession. So I think they are trying to sort of get ahead of that, but they're also fighting the potential resurgence of the animal spirits, right? Because if you cut rates, and Powell also talked about ending quantitative tightening in the coming months, if you do all this stuff, you do run the risk of reigniting the animal spirits in all of us, right? They're there. It's just a matter of does the monetary policy allow for it? Now, you could argue, they've been cutting rates for well over a year now. So why has it not had an effect on, the riskier of assets, right? Like, why has it not had an effect on altcoins and all this other stuff? But one of the arguments, and I've made this argument before, is that the Fed funds rate, while it is true that it has been dropping, and it's true that they're going to continue to bring it back down, the problem for the people that think that automatically means their altcoins are going to pump, the problem is that it's still higher than the 2-year yield, which again is arguably an approximation of the neutral rate, right? Of the neutral rate. And so if we overlay the 2-year yield and the Fed funds rate, right, like, you can see that historically the Fed funds rate follows the 2-year yield, right? So the 2-year yield will make its move first, and the Fed funds rate follows, not the other way around. So remember, the 2-year yield tells the Fed what to do. The Fed does not tell the 2-year yield what to do, right? The markets will tell the Fed what they need to do, and the market is continuing to tell the Fed that they need to cut rates, right? And so again, like inflation is moving up in the short term. Market doesn't really seem to care that much about it. And one of the things that you'll notice is that back in 2021, the 2-year yield was spiking back in September, right? It was spiking, but it basically took 6 months for the Fed to respond. And that was arguably one of the reasons why inflation got more out of hand than it really needed to. Is like, why did they wait 6 months? Like, why? I mean, it's obvious in hindsight, right? So it's easy to give them a hard time. It's easy to be that armchair economist. But usually the Fed goes where the 2-year yield is going. So if you're over here wondering, if inflation hasn't been at the target in 4.5 years and inflation is currently moving up, why are they cutting rates? Well, that's what the market's telling them to do. And again, I mean, there's a lot of nuances and things. Just because inflation is moving up now doesn't mean it's going to be moving up 6 months from now. And they potentially want to get ahead of this. And even Powell himself said that they're not cutting in response to bad data, right? I mean, I don't know exactly what he said, but he said that these are risk management cuts, right? They're risk management cuts. So they're trying to get ahead of any bad data, but they also don't want to rekindle the animal spirits inside all of us. So it's really tough, right? It's really tough what they're doing, and how do you actually accomplish that? But if they do cut a couple of times and the 2-year yield kind of stays here, then within a few months, the 2-year yield might actually be below the theoretical neutral rate, if you will. If we go look at the different categories, you can see that food and beverage, that contribution mostly stayed flat, right? And really, we could just look at it per category rather than contributions, because they're weighted differently. Like, we know that they're weighted differently from each other. But if you just want to see like how the different categories are doing, food and beverage inflation actually dropped a little bit, right? From last month to this month. Housing dropped, which is one of the main reasons why inflation dropped, because housing consists of like 2/3 of overall CPI. Apparel went from deflationary back to inflationary. Transportation moved up. Medical care moved down. Recreation moved up a lot, right? From 2.3 all the way up to 3%. Education and communication moved up, and then other goods and services moved up. So, I mean, a lot of categories do seem to be moving up, but because you have housing moving down, and housing represents like 2/3 of the overall contribution, approximately, overall headline inflation came down. Now, if you look at core inflation, it did start to drop, which is a good thing, right? Hopefully that is a new trend here, and hopefully we can watch inflation start to come back down. I think the difficult part with all this stuff is that, like, you can go insane trying to figure out how this stuff's going to affect the markets, right? But at the end of the day, and I've said this for years, right? At the end of the day, markets like climbing the wall of worry, right? And there will be 5% corrections, and there will be 10% corrections. And every once in a while, you get a really nasty bear market and a really nasty recession. Good luck predicting when all that's going to happen. One of the charts we've actually looked at a lot is the the S&P 500 divided by M2, right? And it's actually kind of a fascinating chart because how much it compares to the 90s, right? And one of the things you'll notice is if you take a bar pattern from 1996 and you just overlay it to what we've experienced this cycle, I mean, even that drop in April kind of lines up with the 1998 drop, that 20% drop. And by the way, we called for that drop back when it happened, right? We were looking at this and saying that's resistance. Now you can see we're potentially coming up to this resistance level right here, which could, give you some of these corrections. But again, the party can theoretically go on until the data really starts to turn. Now, here's where it gets interesting. There was a report that came out, I think today, where they basically said that there's a good chance that in November, the inflation data won't even be released. So again, this is the government basically, and I guess due to the government shutdown, right? This is one way of solving our problems. You can't have bad data if the data doesn't exist, right? So we can just go around and, have our hands in our ears and pretend like nothing's going wrong. And then whenever they reopen things and start collecting all that data, we'll deal with that when it comes, right? But why deal with tomorrow's problems when we can ignore them today? Seems to be, how most of this stuff works. So maybe they won't have an inflation report next month. They already didn't have a labor market report back in early October. And it doesn't look like they're going to be reopening the government between now and early November, at least according to the current prediction markets. So this is one of those things where like we're flying blind here. And, by the time they reopen the government, it might lead to one of these corrections, right? Just because of all the uncertainty of like, oh crap, now we have to worry about all the data again. It might lead to one of these corrections. But even back then, if you assume that we're like in like May of 1999, even back then, the market still held on. I mean, it found a top 10 months later, but it still mostly held on for another like 17, 18 months after that, right? Where it was basically the same price. So it's kind of a reminder that, trying to time major turns in the market, it's really hard, right? Like it's really, really hard. And no one has a crystal ball on when these things are going to play out. For things like Bitcoin, it's easy to look at all the CPI data and try to make sense of it and try to figure out like what it means for the market. But again, narrative follows price. The only way, in my opinion, that inflation by itself is going to have a large effect on the markets is if you get a big surprise, right? Where like inflation is so high that it scares everyone, right? Like again, if you look at inflation year over year, and you go back to like the 1970s, and you see like when it peaked, like when the markets were peaking in this move here, as inflation moved up, market didn't really seem to care. But when CPI went from 3.8% to 4.8% in a single month, that's when the market topped out. But as it just steadily rose, the market didn't care. And that's sort of like the market climbing the wall of worry. But then if it gets a big move up, the market can't ignore it. So again, you're not even getting the inflation data potentially next month. You're potentially not even getting the labor market data as well. I'm not suggesting you can't have corrections. I mean, I honestly think the S&P would do very well to have a correction back to its bull market support band, right? I think that would actually be very timely for it and be a much needed reset. I mean, again, if you look at the S&P divided by M2, it actually did the same thing back then as well, where it basically like put in a high. If I can find it. Right, like it put in this high, came back down, and then went slightly higher. Ultimately came down to the bull market support band, rallied again, and then got a deeper dump. If that plays out this cycle, this low could correspond to like early 2026, right? So then this low would be like late October, early November, and then you could potentially have another rally into December, followed by an early 2026 low, and then the market I might just hold on for a while until the data starts to turn the other way. The thing is like there's no guarantee that you get this, because that's what Powell's trying to avoid. He's basically saying, look, if we cut rates now, maybe we can get ahead of this thing. That's what they're trying to do. Okay? If you look at the context of history and see what happened back then in 1998, one of the issues that they experienced back then, let me go back to the S&P actually, because I want to overlay U.S. interest rates onto the chart. What happened back then, for anyone who cares, is they actually, they were raising rates, right? They were raising rates, or sorry, first they were lowering rates in 1998, and then eventually they had to raise rates again because they reignited the animal spirits. And then it wasn't until they raised rates here, held it high again, that they finally killed the market, right? And then the dot-com crash ensued. So basically what happened is like, this whole process went on for years, right? Like 5 years or so, maybe even longer, right? You could argue it went on for like 6 or 7 years, that whole business cycle, and it was, the Fed was over here like trying to lower rates and not have any hard landing. But then eventually, in order to truly kill off the animal spirits, they had to raise rates and then finally send this thing crashing down. Today, you're kind of seeing the opposite, right? Like they're still lowering rates. They're not trying to kill the market right now. That doesn't mean they won't eventually do that if the animal spirits come back, which I know a lot of you guys want that to happen. But imagine if the Fed were to lower rates below the 2-year yield, and imagine they end quantitative tightening, and imagine Jerome Powell gets replaced and he lowers rates even more, and imagine they turn on the money printers and all this other stuff. Like, that's great for your bags, potentially. But the problem is that the macro stuff, like the people that are not invested, it's going to hurt them a lot. And so eventually they might be forced to face the music. But who knows when eventually is? I mean, it could still be 2 to 3 years away for all we know. It could be tomorrow. It could be 2 years away. Given the fact that they're lowering rates right now and we're not having bad data, then it's still theoretically optimistic. The optimism fades when they lower rates in response to really bad data. But again, how can you have bad data if they're not releasing it? Solve solve macroeconomics with this one simple trick. Maybe they should just stop releasing Bitcoin dominance charts, right? And then, we can all just pretend that altcoins aren't bleeding against Bitcoin anymore, right? If the chart doesn't exist, who knows? I mean, it's a really difficult, cycle, I think, for Powell to navigate. And I think what he wants to do, I think he wants to lower rates a little bit more, get them closer to the neutral rate, and then just kind of hold steady and then have him be replaced by someone else. I don't think he's going to lower rates a ton. I mean, I could see him lowering rates down to like 3.5% plus or minus 25 basis points. But I don't think he's going to do a whole lot more than that. If you want more than that, you're going to have to wait for Powell to be replaced. What's really interesting is how, sort of the justification for rate cuts, like why everyone keeps screaming rate cuts when it's like basically everything's at all-time highs, right? Like the S&P's at all-time highs, gold's at all-time highs, silver, I mean, everything is basically at all-time highs. I mean, even Bitcoin is at all-time. You might say, well, Bitcoin's not at all-time highs, but I mean, it hit an all-time high this month, right? I mean, it hit an all-time high this month. So it's funny because it's like, well, everything is essentially at all-time highs, yet we feel this need to constantly lower rates and in quantitative tightening. And again, like this stuff works for a while and it can go on for years and years and years, but eventually the music stops. Eventually we have to face the music and we're just kind of kicking the can down the road for as long as we possibly can until that music actually stops. Back in the 1990s, it took years for the Fed to come to terms with what they actually needed to do to sort of move on from the mess that was created. But again, I mean, this is a different cycle in a lot of ways. There are similarities, but it's also there's just some differences as well. And we'll see how it plays out. But with inflation again, if you're looking for how these like slight moves up, slight moves down are going to affect the markets, you're going to drive yourself insane, right? Narrative follows price, not the other way around. The only way inflation is going to have a huge effect on the markets is if it gets a really big move up or a really big move down. And in both cases, it's bad, right? Like if inflation next month, if we were to get the data, which we're probably not, but if we were to get the data, if it went up to 4%, that would be bad. If it went down to 2%, that might also be bad because then it's like, well, why is it dropping so much? Is demand just completely drying up? Again, these steady moves give the market, a little, at least some confidence that nothing is going super awry at the current time. It's when you get those big moves in one direction or the other, that's when the market tends to get spooked, and we haven't had that. And so I don't imagine that Bitcoin is going to have strong reactions to CPI that's barely moving. Okay. But I mean, I've gone on long enough. These are my views about inflation and how Bitcoin. One thing about this though that we can say, I'm so glad I remembered, I almost forgot. With inflation going up, you know what it is bullish for? It's bullish for Bitcoin dominance, right? It is. Because while they are going to cut rates, they're still not going to cut rates enough to get them below the neutral rate. I mean, they're not. Maybe if inflation were dropping, they would, but they're not. So a rate cut is fine, but because it's still below the neutral rate, it still likely is going to be bullish for everyone's favorite metric, Bitcoin dominance. And the reason for potentially not more aggressive rate cuts is because inflation is going higher. And who knows why? I mean, could be tariff related. It could just be this cyclical component. Who knows? There's always a narrative for everything. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.